Ever get cornered at a party? Someone's like all fired up about some stock tip. Like, oh, it's been killing it this month. You got to get in now.
Yeah, been there.
Right. Total FOMO moment.
Hmm.
Makes you want to jump on that bandwagon. But today, we're really digging into why that can be, well, a recipe for disaster.
Yeah.
We're tackling this whole thing about past performance. Can it actually guarantee future success, especially when it comes to investing?
Right. And that actually perfectly brings us to Jack Schwager's Market Sense and Nonsense.
Yeah, very appropriate for this deep dive.
It really is.
Okay, so logically, it kind of seems like, yeah, chase those high returns, right? If something's been doing well, shouldn't it keep doing well?
Well, I think that's a very, very common misconception.
Oh, is it?
Yeah.
Okay.
And Schwager calls that out as investment misconception 8, invest in funds with strong return records. And he basically says that you have to look past just the returns themselves. People misunderstand what drives them.
So it's not enough to just see those big numbers. We got to know what's going on behind the scenes.
Yeah, you have to understand the why.
Okay.
And what he says is that the strategy of a fund, how it invests, even just the market itself, can totally change how well it does. It doesn't mean those past returns will happen again.
Okay, so you're saying like just because a fund, let's say, crushed it last year, that doesn't mean they're guaranteed to crush it this year.
Exactly. Like, let's take merger arbitrage hedge funds, for instance. They try to make money when companies merge from the price differences and stuff.
Right.
But they need the right market conditions. It's not just about skill.
Okay.
So past performance alone doesn't tell you if those conditions will stick around.
So it's like the market has to be in the mood for mergers, is what you're saying.
It's got to be ripe for it, yeah.
Gotcha.
And an even more extreme example, this happened in 2008, 2009 with these convertible arbitrage hedge funds.
Oh, yeah, during the crash, right.
Yeah. In '08, they had massive, massive losses. Then '09, they have record-breaking gains.
What? How does that even happen?
Doesn't sound very consistent, does it?
Not at all.
Yeah.
Not at all. Did they suddenly become, like, geniuses overnight? What happened?
No. It was market conditions again. In the crash, convertible bonds were, like, on fire sale.
Convertible bonds, that's the kind that can switch to stock, right?
Exactly. And then they rebounded like crazy in '09. So these funds, they just rode that wave. It wasn't some magical skill.
Wow. Okay, so that totally changes how those returns look, right? Like before, you'd think, oh, they lost big, then won big, they must be amazing. But
Yeah.
it was just the market being the market.
Exactly.
So chasing those hot strategies, it's feeling a lot riskier to me now.
Well, it should. This is actually what Schwager was getting at sometimes. If you see super high returns, especially for certain strategies, that's a red flag.
A red flag.
It might mean that strategy depends on something very specific happening in the market, and then that could change like that.
It's almost like that kid in high school who everyone's like, oh, they're going to be somebody. And then
Right.
life happens. Past performance is just one moment in time. Doesn't guarantee anything.
Exactly. It's one snapshot.
Yeah. And speaking of cautionary tales, Schwager uses a really big one to show how dangerous it is to just focus on past returns.
Yeah.
I think everyone listening knows exactly which one. Countrywide Financial, right?
Right out of the headlines, yeah.
Okay, so for anyone who's maybe blanking on the details of the whole 2008 housing crisis,
Yeah.
set the scene for us. What was going on?
All right, so picture in mid-2000s. The housing market is on fire, right? Prices going through the roof, everyone's feeling good. And fueling this whole thing, these things called subprime mortgages, basically loans, but to borrowers with, shall we say, not the best credit.
Right, risky borrowers.
Exactly. And countrywide, they were one of the big players handing those out, like giving them out left and right. But here's the thing, a lot of those borrowers, they weren't really in a position to pay those loans back. Made them super risky.
Yeah, those are the infamous liar loans everyone was talking about back then. Okay, so if it was so risky, why were companies like Countrywide so into it? Seems crazy now.
Well, it's that allure of past performance again, right? Everything looked fantastic on paper, prices going up, 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 felt like easy money. Nobody wanted to believe it could end.
But it always does, doesn't it?
Sadly, yeah. And this is where things get really interesting and scary if you're just focused on those past returns. Even back in 2006, there were signs, warning signs, that things were off.
Like what?
Delinquencies, those are people falling behind on payments. Those were going up, especially on those subprime mortgages. Foreclosures, too. Those cracks were starting to show, right?
So the party was winding down, but nobody wanted to leave yet.
Pretty much. And here's the kicker. Countrywide stock price stayed high. all through 2006. Investors were blinded by what had happened before, ignoring the red flags right in front of them.
Like the market was living in a different reality.
It's true. And Schwager, he has this chart, figure 2.8 in the book, it's wild, shows you those subprime ARM foreclosures, those adjustable rate mortgages, those are huge back then, plots them right alongside Countrywide's stock price. And the timing is crazy, foreclosures going up, up, up all through '06 with that stock price. Doesn't crash till '07, shows you how slow the market can be to catch up to what's really going on.
And the people who held on, who believed those past returns meant something.
Yeah. Not pretty. Countrywide, it's like a masterclass in why you can't just look in the rearview mirror when you're driving, Tells you where you've been, but not where you're going.
Okay, so we've seen how those past returns, they can be misleading, to say the least. So what do you look at? If we can't rely on those numbers, then what?
Well, this is where you got to go beyond just the raw data. You got to start thinking about what Schwager calls hidden risks. Basically, those potential problems that might not be obvious at first, but can completely change the game.
Hidden risks. Okay,
Awesome.
sounds ominous. I like it. What kind of things are we talking about here? Give us an example.
So one of the biggies, and it trips people up all the time, is leverage. Now, leverage itself, it's not good or bad, it's just IS. But people misunderstand it a lot.
Yeah, leverage. That word alone can make my head spin. Break it down for us. Pretend we're back in high school. No clue about investing.
All right, so think of leverage like borrowing money to invest. You're basically saying, I'm going to amplify my wins, but also you're amplifying your losses if things go south.
Okay, higher stakes, got it.
Right. Let's say you got $100 to invest. You could just put that in, or you could use that 100 as collateral, borrow, say, 400 more on top of it. So now you're investing 500, but with that risk attached. That's leverage.
Okay, so more skin in the game, potentially bigger payout, but also way bigger risk if things tank.
You got it. And here's where it gets tricky. People see leverage and they think, oh, risky. But it's not that simple. It depends on what you're leveraging.
So it's not just the amount of leverage, but what you're actually using it for.
Exactly. Like Schwager, he uses this great example of two fixed income funds. Fund A, no leverage. Fund B, leverage. But Fund B is invested in things that aren't as affected by interest rate changes.
Wait, so you're saying the fund with leverage could actually be less risky than the one without? Hold on. My brain's trying to catch up.
Right. It's counterintuitive. Think of it like a speedboat versus a giant cargo ship. The speedboat, it zips around, seems riskier, but that cargo ship, if it hits something, way bigger problem.
Okay, that's a good way to put it. So we can't just see leverage and freak out. We got to know the context, right?
100%. And this is where doing your homework comes in. Ask questions. If someone's pushing an investment based on past performance, don't be afraid to dig deeper. What were they actually investing in?
So, okay, we got all these red flags to watch out for, right? Past performance, maybe not so reliable. Leverage, got to know the details. So what's the big picture here? What are we supposed to do with all this info?
You got to treat investing like a detective, basically. You wouldn't just, convict someone because someone said they did it, right? You got to see the evidence, the whole story.
So those flashy past returns, that's like the suspect's alibi. Sounds good at first, but...
You got to dig deeper. Exactly. Like, if someone's pushing you on an investment, oh, it did this well, that's when you ask the tough questions.
Like what?
What was the market like back then? When those returns happened, what was their strategy? Anything suspicious going on?
Don't be afraid to be a little skeptical.
100%. No one likes feeling dumb, but better to ask now than lose your shirt later, right?
Right. So, due diligence, that's our takeaway here.
Big time. Read the fine print, all that stuff. Talk to someone you trust, a financial advisor, whatever. Don't just jump in blind.
Man, this is making me realize I've been kind of playing roulette with my investments, huh? Just hoping for the best. But there's like a whole strategy guide I've been ignoring.
That's a great way to put it. And the house always wins if you don't know how to play.
Right. No more gambling for me. I'm going to be a strategic investor from now on.
That's what we like to hear.
So, next time someone at a party hits me with that hot stock tip, I'm ready. I'm armed and dangerous. With knowledge, that is.
Best defense there is.
Absolutely. Well, this has been awesome. Really appreciate you breaking all this down, this whole past performance myth.
Yeah, of course. Glad we could dive into it.
For everyone listening, remember past performance.
Yes.
Just one piece of the puzzle. Do your homework, ask those questions, and keep learning.